Welcome to another episode of Investing with IBD. It's Justin Nielsen here, and it is Wednesday, June 5th, and Arusha's not able to join us today, but that's okay because we've got a great guest coming back to the show, Jeffrey Hirsch from the Stock Traders Almanac. He's the editor over there. His father, of course, started the Stock Traders Almanac back in, what was it, 60 years ago?
Not quite.
Not
58th
quite.
edition.
Okay, 58th edition. Okay, so quite a while ago. So there's a lot of research that's gone onto the Stock Traders Almanac, and we love bringing Jeff on periodically. I mean, we had him on at the end of January to talk about the January effect and the trifecta, and it's midway through, and it's often good to have Jeff come back on halftime for the halftime show. He's our little halftime presentation. So we're going to kind of get into some of the stuff that Jeff has talked about before. But it's a good reminder for folks of the seasonality. And we're going to get into a lot today. So, Jeff, welcome back to the show.
Great to be with you. A little sad that Arusha's not here, but
I know it is. It's
we'll
we're all
well
gonna
in his honor.
Right. We'll pour a drink out for Arusha. And you know, I actually just had him over to my house this last weekend, so we got to pour some drinks together. We've been spending a lot of time in person lately, so yeah, I'm kind of sick of them. Yeah, no, I'm just kidding. So yeah, Jeff, let's get right into it. And we can start with the S&P 500 because certainly one of the things that was interesting here on the S&P 500 is you really called this market bottom back in October. Well, actually, I'm gonna go to the weekly real quick because it was really the October 2022 bottom here that you called.
Yeah,
we had
beautiful.
That was the one.
That was the midterm bottom. I mean, it was textbook.
Yeah, textbook. There's a lot of data, again, as I've said, that you have in the Stock Traders Almanac, and you've just been looking back at history and saying, hey, this is what's typical. This is what to expect. This is what, your odds are. 2023, very powerful, kind of had another little, a little bottom here and a really big move into the end of the year. And last time you were on the show, we talked about the Santa Claus rally. Didn't quite get that. The first 5 days, those were just ugly. I mean, the index started out and it was just a ton of selling, but the way that January ended was very strong. So you got 1 out of 3 of your trifecta. So kind of remind folks what that sets up for you.
Well, I mean, the January barometer was the original, earlier indicator that Yale came up with. He invented the Santa Claus rally last 5 days of the year, first 2 of the new year. And the January barometer in 72 came out in the 73 Almanac. The line of Santa Claus should fail to call, bears may come to Broadwell. That's something he coined, the old songwriter in him. And then the January barometer, as January goes, so goes the year. You and I were talking about amendments when we were getting ready. The 20th Amendment to the Constitution, when new Congresses, were made to convene in January, not 13 months later in December, and presidents get inaugurated January 20th, not March 4th like it used to be. That combined all this stuff into January, made January a very important market month because decisions get made, agendas get set, policy initiatives, et cetera, so forth. Over the years, we've seen some selling in January, some profit taking, like you just mentioned at the beginning of this year. And what we did was we combined this old first 5 days early warning system, which was something that was invented a long time ago, with Santa Claus rally January barometer. And when all 3 are up, you have the market up 90% of the time, about 17.5% on average. And then when you get, one of them down, it sort of reduces the results. But as we were talking about, very timely on the last trading day, or just after the close of the last trading day of January this year, January came in positive. That is, of the 3 of them, that's the one you want to have positive the most. That's the one that supports the market. And that was kind of, helped us confirm our annual forecast based upon market cycles with the 4-year cycle and the sitting president running. But better off getting all 3 like we had in 2023 with hitting the trifecta with all 3 of them. It wasn't the case in 22. So it's part of, the toolbox, part of the what we use to navigate the markets using history and current readings, whether they be fundamental, technical, or monetary, or what have you. So it's not just cycles. You want to see that the market's tracking them or not, and what the other indicators are out there, like things like the 10-year note that seems to be driving things lately. But
right. Well, we'll definitely get into some of those fundamentals. As you often say, there's kind of 5 disciplines that you look at. And just to kind of give people a preview of that, can you just name what your 5 disciplines are that you focus on?
Seasonality, our foundation. Fundamentals, like GDP and such. Technical analysis, monetary policy, and sentiment.
Okay, perfect. So we'll be getting into some of those, but since you mentioned technical, let's go ahead and shift over to the NASDAQ. And it should be mentioned today, both S&P 500 and NASDAQ Composite at new highs. So here's the NASDAQ. And, look, we had a kind of a rough April and May, and even this last day of May was a little bit tricky. I mean, it really kind of came down to the 21-day moving average line, got support. It was looking ugly, at the lows, but then at the end of the day, it's like no harm, no foul. Everything, looked fine, right?
That's some of the choppiness we've been seeing lately. I mean, if you look at the chart there, it might have felt a little rough on some of those days, but I don't know. We're up at new highs today. We've been hovering around the new all-time highs for a while. A little correction here and there. It's just some rotation, as you've mentioned to me that we're looking at, and some profit taking, and a lot of noise. A lot of people trying to game the Fed and this data point and that data point, but pulling out a little bit like we do here with the cycles and the patterns and a little time, you can see that we're still in a bull market. We've been in one for quite a while, and the selling that we've had is not to be it shouldn't be surprising to us considering how far we've come.
Yeah.
We talked about the best 6 months and the sell in May period. At the end of the best 6 months in April for the Dow and S&P, we were up twice the historical average of that best 6 months, November to April period. So, it's not crazy to think we might have a little selling, a little chop, a little profit taking.
Well, to your point, I'm going to pull up another one of your charts here. This is the NASDAQ seasonal MACD. And you had this in a presentation that you gave to subscribers. And just to remind folks, where could people go to subscribe? And I should also mention that you get Stock Traders Almanac with that subscription, which is very invaluable. But where should people go to kind of get this information that you're getting?
It's pretty simple. StockTradersAlmanac.com.
Yes, just that easy.
If you start typing it in Google, it should come up.
Right, exactly. That's good SEO right there. So tell me why you're saying that the MACD is kind of almost at a sell, not yet, but close.
So,
and for how long?
Well, the market will decide how long, depending on what it does. But we start looking for a sell signal for Dow and S&P when in the last month of the best 6 months. That's best 6 months, November to April. That's where everyone gets their sell in May thought process going. So we issued a sell signal for MACD for Dow and S&P using the MACD sales trigger. You can see there's 2 MACDs on this chart: 12.26.9. The previous one.
Sorry.
No, that's okay.
Yep.
12.26.9 is the up one that I've got the little yellow box there. That's the sell MACD. That's the one everyone thinks they use for everything. The original research done by the late Jerry Appel, who invented MACD, the 8.17.9 is the one you use for the buy side. So, and you want to have it's a different reason for buying or selling. The MACD confirms that. So for this, it's the seasonal pattern. For you, it might be the O'Neill factors for getting into a stock. Use MACD to enter or exit. But what we're looking at here is the NASDAQ, which has a best 8 months that runs through June. And what we do is to get out of that seasonal trade is we wait for a crossover, a new crossover on or after the first trading day of June, to indicate it's time to get out of the best 8 months for NASDAQ, which we'll be looking at close. So what we had here is the selling that you were talking about at the end of May put the MACD slightly negative. But we came into the month negative, so we can't have a signal because you need a fresh signal. The last couple of days, especially today's big gains, put the histogram, if you will, the difference between the MACD line, the blue line on that chart, and the pink line, which is the signal line, they made it positive. So now we can get a trigger. and this will be something that we'll send out to subscribers, after the close that day that it triggers. It could happen any day now because we're so close. The market keeps going up. It puts a little distance between the two lines, and you need more of a sell-off to get that trigger. But I would suspect it would happen sooner than later. I don't think it's going to be an end of June best 8 month sell signal for Nasdaq, unless we go straight up for the next several days. It'll probably trigger shortly.
Okay. Now, you mentioned how strong May was, and you have some more data here in terms of when May is strong. And again, there's the sell in May, go away, but May was so strong this time. Does that kind of change your thinking?
It's part of our thinking. It doesn't necessarily change it, but the thing that we've seen with seasonal patterns over the years is that when they don't work, they become an indicator. Okay, so if the market doesn't do what it normally does, that means there are other forces that are at play, and when that period's over, those forces will really have their say. I think that rhymes, actually. But,
yeah, not bad.
So, what we have here is May, notoriously, rough month. Market hitting a new all-time high, being positive, and this table here that we presented, the election years are what's highlighted in yellow there. Shows us that when you have a strong May, May is above 3%. It's an indication that you're in a strong market. That the usual weakness that you might have, or the choppiness that you can have in those weak months, the sell in May period, the May through October period, what we call the worst 6 months, may not be so bad, or maybe more muted, or less pronounced than previous years. And this dovetails very well with the last 7 months of election years, where you have only 2 losses in the last 7 months of election years. What happens is, as we get through the summer, you start to have a real clear picture of who the candidates are, who's running, removes more uncertainty from the market, and then you have the incumbent party continuing to prime the pump. As we get towards the election. That's why we have this pattern of the last 7 months of election years being strong, and here we have May being up, confirming that. So you've got another sort of convergence of seasonality and election cycle, patterns here.
Yeah.
All bullish.
Right. Okay. Well, you know what? I'm gonna save the election for our next segment, but maybe we can skip ahead and get a little bit into your fundamental side. And one of the things that you were talking about. I mean, we've got the Q1 GDP revised lower. So there's this element. There's the inflation. You mentioned the 10-year Treasury. That inflation is moderating, but needs more data before we saw a big, last time you were on, I think the projections for how many rate cuts we were going to have were just starting to kind of come down.
Those weren't our projections.
Oh, no. Those
are the streets.
Right. Yes. Yeah. Just to be clear, but I mean, what was it at the end of the year? The projections were for 7,
6 or 7. Yeah.
Yeah. It was just ridiculously high. And I think you said at the time, like, that's not happening, but now that we're halfway through, I think everyone's kind of saying, okay, what's kind of your change in this, Fed movement here?
I mean, we were probably thinking back then in December, I think it was like 2 or 3 we were saying. Now it's like 1, maybe 2, maybe 1. This projection, we had the 2% month over month, which puts us in that gray line there in the middle, getting close to the Fed's target of 2%. But we're going to need a couple of data points in a row down there. So looking at the CME futures, which everyone's watching nowadays, it's about, when I did it earlier today, it was about 57% of a quarter point in September, 80% flat, unchanged in July. I mean, June's not going to happen. But these are not super convincing numbers either for September.
Well, I would say that, I mean, the CME, this has been notoriously off. I mean, for a while, it hasn't been that good at
it hasn't
projecting out.
Which
maybe
really
good for the near term.
Knows. Right. Nobody knows.
Yeah, maybe good for the near term, but the further you go out, these these futures have been way off. So yeah, definitely an issue there. And you know what? Just again, to kind of talk about one of your other disciplines before we get to kind of the election, if we could just kind of touch on the sentiment real quick. What's your
Yeah,
and you mentioned this last time. I think you've mentioned it every time.
a couple times.
Sentiment is certainly better at bottoms than tops
As an indicator,
as an indicator, right?
sentiment is usually horrible at bottoms, but as a contrary indicator, it works much better. When when sentiment is really bearish and the market is down, as I've highlighted here on the right side there, excuse me, left side, over there is this difference of bullish and bearish advisors for Investors Intelligence back in 21. You can see how long you can stay very bullish while the market rips, or excuse me, powers higher. I don't know if that's a rip. I don't know what you want to call that, but it continues to rally through this supposed contrary bullish sentiment. So market can stay bullish and through bullish sentiment for many months. The better part of a 12 right there that it rallied like that. And then we could be in a situation similar to that. I would doubt it would be the same. I mean, this was coming out of COVID with money just floating everywhere, everyone buying anything they could, and I don't suspect it'll be quite as much of a rip moving forward. And we are getting into some of the election stuff that you want to get to, but sentiment here not as concerning. When it's super bullish and the market's up, it can stay high with the market for a long time.
Okay. Well, let's go ahead and put a pin in that because we've got a lot to talk about with the election coming up and, more importantly, what that typically means for the market. So stay tuned. We'll be right back. Welcome back to Investing with IBD podcast. It's Justin Nielsen here, along with our special guest returning to the show for his halftime show. It's Jeffrey Hirsch from the Stock Traders Almanac. He's the editor over there. Something that his father, Yale Hirsch, started 58 years ago, nearly. And so let's get into election years. And I'm going to go ahead and start just because in the last week, we saw some pretty crazy reactions to elections. Mexico had a historic election. They got their first female president, Claudia Sheinbaum. And of course, this was not unexpected, but maybe what was unexpected was how much of, congressional kind of help they were going to be getting. And it's also worth remembering that the incumbent president had tried to get a number of things passed, didn't have a Congress that was necessarily on board with that. And, now he's going to have a month with a very, let's say, more favorable Congress. So that was certainly something that took a big hit. It's really, how often do you see a ETF, a country ETF down,
right?
10.7%, yes, on the day.
In one day, right? Yeah.
In one day, yeah. Now it has recovered a little bit in the last couple of days, but on the flip side, not as dramatic. But Modi over in India was looking like he was going to get another term. Maybe not as much of the help from the legislative body, and so before we closed, it was looking very strong. The next day, of course, the election results were in. I think that they didn't come in until 10:30 p.m. Eastern time. And so by the next day, it was kind of like, oh, yeah, he won, but is it going to be tougher for him to get some of the, very market favorable policies that he's been trying to enact to continue? And I mean, so you were up 3.3%, 3.4% a couple days ago, down 6% after the election results kind of came in, and then you were up 3%. So very, very volatile. And let's not forget, it wasn't that long ago that we had 2016, and 2016 started with a very important election with Brexit right in here. That kind of surprised a lot of folks, but came right back. It was a little bit of a ugly move, though.
We had a little discussion back there in June 2016 about the seasonal trade. And, because people were thinking that it should be get out of the way because of Brexit. And we said, no, stick to the seasonal pattern. We had that nice end of June, July rally there. So it's sometimes these little events people overreact to, and it's not as
Yeah,
much of an issue. So, well, the seasonal pattern worked there,
right.
despite what everyone's concerns about Brexit.
Yeah, and I think, when Brexit, when that vote happened, it was an immediate kind of, oh, what are we going to do? Oh my gosh. But then it was like, wow, this isn't going to happen for a very long time. I
Yeah.
think people started like doing the calculations like, oh, there's a lot to be done here before anything happens. And then of course you had the US elections, running into that, kind of came down, but then I'm in the wrong excuse me.
That's India's up there.
Yeah, I don't want to be in India right now. So here we are with the Brexit, and then in the election here for the U.S., you kind of came down, and overnight that was a little crazy how the futures were. But man, after that election was done, you were really off to the races as it had a very strong and very low volatile time period in 2017. So let's kind of switch gears maybe and talk about where we are in our seasonal. I'm going to go ahead and switch over to some of the charts that you have provided us. So if you just give me a moment to switch my screen here.
While you're doing that, I think it's interesting with the governments that you're talking about, India and Mexico. The thing that I pick up on is like the market friendly parties are the ones that's moving the markets. In Mexico, you have a full, what would be like, Senate and Democratic Congress coming in there, which is not one of the best combinations for the research that I have on political alignments for market performance in the U.S. So I would, sense that people are feeling the same things. That you've got a progressive government, in agreement, unified, that's going to start changing things and costing businesses a lot more money. Whereas if you have a more conservative legislative body, the key to market performance from the U.S. markets has been Republican Congresses. Best combination is Democratic president, Republican Congress, where you got that working together there.
Or not necessarily working together, but sometimes nothing gets done, and the market is very okay with that.
Precisely.
Yeah. Okay. So let's go ahead and take a look at our, how we're tracking this S&P 500 election year seasonal pattern. And again, what you've done here, I mean, you're looking at the data from 1949 to 2023. Tell us how we're tracking so far.
Well, the red line is our aggregate cycle. That's a combination of all years, this 1 year seasonal pattern, election year seasonal pattern, and then the fourth year of the decade, like 2024, 2014, 04, that kind of stuff. And you can see, the red line's a bit more flatter. It's more things that are averaged out there. But when you put in the sitting president in the black line, and then the sitting president without 2020, because we had the COVID situation, which showed that a little more pronounced sell-off there than we had. You're looking at a pretty bullish trajectory with that big black arrow pointing higher. But this year, 24. Now, this is just at the end of May. We don't have the last few days in there, but we all know what's happened there. We're up at a new high. It's cantilevered well above the average. So what this means for us here is two things. Number one, the market's much stronger than normal, and number two, we're likely to come back to the mean a little bit, at least partially over time. So we're looking at a potential for a little, more sideways, a little chop here as we, let the historical patterns catch up with the current. But all of this bullishness is supportive of a bull market and continued strength in the market. So not much to get negative about here, other than the fact that maybe all of the great gains you've had so far, might be a little harder to come by moving forward, at least for a little while. We'll be getting to the until the conventions are done. Not that we don't know who the candidates are going to be.
Right.
We've got, which is another point that we want to get to, that we've covered. We've got two known entities here. One of two previous presidents is going to be, in office unless something changes, some weird swan event of some kind. Right. And that reduces the uncertainty factor. I think several of the Wall Street CEOs are like, whoever's in, we'll be able to adjust. We know what to do.
Yeah, we know what's coming.
and the market's performance this year is supporting that and reinforcing that the market knows what's coming, so it can be prepared to go higher and continue to go higher.
And let's go ahead and let's take a look at the Nasdaq. Now the Nasdaq was a little bit um, wilder, I guess. I mean, it, whereas the
More volatile.
yeah, more volatile. Yeah, I guess that's the technical term, but I'll just go with wilder right now. Whereas the S&P 500 certainly, as we mentioned, came down in April. It was still tracking well above, the blue line and the black line here. But for the Nasdaq, we were kind of getting into, it
Back
came
to the
right
mean.
down. Yeah, back to the mean. So, but as you mentioned, hey, now we're back. Just kind of project out a few days here. We're right at highs for both the Nasdaq and the S&P 500, well extended above the norm. And there has been kind of a little bit more chop. It's felt like there's been rotations about to happen. This is certainly felt like a market where if you bought on strength, sometimes that's tough because then like a rotation happens almost immediately. You definitely have the market, the market as it stands. If you're looking at the Nasdaq, S&P 500, you've got some big, heavy market cap weighted instruments that are really kind of driving those indexes forward. Sometimes you don't quite get the participation of everybody. It's just that if you've got, a handful of stocks with these big market caps, you're doing just fine, right? Does any of that come into play? And you have any thoughts on that?
Well, I mean, we always have market leaders, and we're still in the queues. We're benefiting from that. I'm okay with a handful of stocks leading the market. I don't like chasing stocks. I'm not into just getting into stocks because they go up. We like things that are great valuations, showing some strength, but kind of under the radar. So I don't think anyone should be chasing in there right now. We're in pure like full cautious mode right now as we're getting into the worst 6 months. We're between the end of the best 6 months and into the end of the best eight. So there's no reason to jump in here and go crazy. We can earn some money in bonds and but we are rotating. You were mentioning rotating sectors. We like staples, healthcare, and we've been in utilities for a couple of months now. We're starting to get benefit from that. So it is time for rotation. I mean, people talk about sell in May and go away. I say reposition in May.
Okay. Yeah.
Rotate.
Rotate. And just one more thing on the chart here that I want to point out, because we do have the conventions coming up, and it looks like typically we've got election year summer chop ahead of conventions typically. So maybe talk a little bit about that.
Well, that's sort of what holds the market back a little bit until it has a clear picture as what the two choices are going into the election time. And you can see that represented on this chart here. I got a little, down arrow or sideways arrow, a little bit down there. Nothing of any consequence on the downside, but you're also talking about the summer period where people tend to do some different things. You tend to see, the end of July kind of weekend, as people take off and vacation and step away from the market. And, then you're starting to pay attention to what's going on in the political conventions, and it just draws attention and money and trading away from the stock market. So again, I'm not expecting any major upside or downside over the next couple of months, but when we get closer to the election and to the end of the year, I think we're going to have a nice rally again and see more new highs.
Yeah, and that's typically what happens. So we've got a little bit of time to kind of potentially go through this chop before things get really strong, at least historically. And one last chart I wanted to kind of end with, because I don't think that we really kind of covered this, but since we're in June, let's talk about what typically happens in June. It's the third best S&P 500 month in election years.
It's the third best month for a few of them. We just picked that one because that's what everyone follows for the headline there. But you can see the Russell doing pretty well. That may have something to do with the rebalancing that happens. But in general, if you can use your mind's eye to picture the last few trading days, it looks real close to what the seasonal pattern is, both for the recent 21 year and the longer term election year pattern. So, you and I have covered the 4-year cycle, the big chart that I've shown you where these 4 years are tracking those 4 years, and the longer it stays tracking, the more it's likely to continue tracking. We're seeing that happen again here, in the near term with just, the election year June pattern. So, people just gotta be a little patient, and
Mhm.
everyone wants to have to buy something new every day.
Right.
Was it Buffett that said, cash gives you time to think or something like that?
Hmm.
It's okay to wait. Like,
Yeah.
what stock are we buying today? I don't know. Maybe not. Maybe not
Hmm.
buying anything right now.
Hmm. And certainly, again, what this market has been kind of notorious for is if you're out there chasing things, if you're like, oh, this is the headline, stocks, and they're getting up there so far, and I missed out, and I have to be in the stock that everyone's in. That's usually been kind of the kiss of death.
We recommended utilities, the XLU, on March 7th to our newsletter subscribers
Hmm.
ahead of this. And everyone's talking about utilities now. Well, that's why and how we use the seasonal patterns, the 4-year cycle patterns to anticipate things, to get in ahead of these potential moves. So
Hmm.
here we are, utilities are up. We're looking at a decent, what, 13-14% gain in the newsletter portfolio. I do own XLU myself.
Hmm. And
Back
I
then.
mean, this has been kind of an unusual thing for XLU. XLU is usually thought of, the utilities are usually thought of as that kind of defensive thing. That's where people go
Mhm.
park their money and hide it, especially when bonds weren't giving you anything in terms of
Right.
yield. This was where you were getting at least some yield from, typically dividend paying stocks. But, there is this component of it's almost more tech related now because there's so much technology that's requiring power. I mean, I think the
Hmm.
numbers that I've heard are AI chips require 7 times more power than traditional chips. You've
And
also got EVs, and go ahead.
And no, and guess what? And additionally, those data centers, they don't only need electricity to run the chips, they got to stay cool.
Yep,
They
absolutely.
need air conditioning.
Yeah.
And who powers the air conditioning? The utilities. And
Hmm.
what is the biggest thing that powers those what's the thing that goes in there, or the stuff? Natural gas.
Hmm. And
So
even
I mean,
coal,
and even
coal was doing
coal.
good for a
Right.
while. So yeah, there's.
It's just part of the whole, it plays into the seasonal pattern. You've got, the climate issues, you've got the electricity demands. So you've got a little, macro trend with EVs and AI, but you've also got the seasonal, heating, cooling, electricity needs for the summer period, all sort of converging on this utility trade.
Yeah. So we're going to get back into some more of these rotational plays and some of the things that are on Jeff's radar when we come back. Stay tuned. Welcome back to the Investing with IBD podcast. Justin Nielsen here, along with our special guest this week, Jeffrey Hirsch, returning back to the show from Stock Traders Almanac. And, you gave a lot of information. And again, the Stock Traders Almanac is something that so many traders use to kind of get a gauge of that seasonality, what to expect, what history kind of tells us. And you've already mentioned stocktradersalmanac.com is where folks can kind of go to get their own almanac and also kind of get updates to what your thinking is, what history's kind of telling you. Also, you share a lot on X,
Mhm.
formerly known as Twitter,
Right.
at Almanac Trader, and kind of give folks a little bit of a sense of what you put on those two platforms.
I mean, admittedly, I'm still not over to X yet. I still think Twitter, but
That's
it's
okay.
basic.
I'm with you.
It's basically a blog post, and what we do on the blog, and we put sort of real concise versions of it out there. Is sometimes it'll be trading ahead of the options expiration or around Memorial Day. It'll be little quirky things into the almanac. I'll give you a little bit of the update from the newsletter, and at stocktradersalmanac.com. It's really our newsletter, our weekly issue that we put out. Some of the slides we've been going through today comes out of the members only webinar that I did earlier today, and this is what we do every month, and
Mhm.
that comes out of the outlets that we put out there. So we take all the history, all the seasonality, and put it together with the 5 disciplines, and guide people through the market and have buy and sell recommendations on stocks, ETFs. But on Twitter and on the blog, it's gives you a little taste of the important thing for that day, that week. Sometimes I'll go into commentaries about what's going on in the world, the market, but for the most part, we try to keep it straightforward. And here's what to expect on this day, this month, turn of the month or this little trading pattern. But you're not getting buy and sell recommendations on the on Twitter.
Right. Well, speaking of one of the buys that you put out a while ago, and we'll just kind of revisit this because I do think we covered this in January, but you mentioned data centers, and certainly
Yeah.
one of the big kind of behemoths in terms of, hey, putting those computers together and all the components in a very efficient way. You've got Supermicrocomputer, which I think you were into this back in the 80s. Not
Yeah,
not
well,
not
it was
not the 80s time frame. We're not wearing neon.
80 hands, yeah.
Right.
We picked up Supermicro in November 22 at 81.93. We took some profits at a double, way back, and then we just sold half of our remaining position, so we're down like a quarter position. We sold a little bit more around April 12th. I think it was about 900 or just under 900. So, we're not buying this right now. We're holding it. I'm sorry to tell everyone that I don't have a whole bunch of stocks to go buy right now. I'm not chasing stocks.
Mhm.
Some of the other ones that I think fit into the sort of theme that you were talking about with this, utilities and AI, driving this market sector. There's a couple other ones. It was Invent Electric, another one that's on hold, NVT, and MCore Group also, EME, I think we mentioned that before, is involved in the data centers.
Mhm.
One of our other big cap stocks.
What was that last one after NVT?
MCore.
Oh, MCore,
EME.
yeah, EME. Mm-hmm.
Edward, Mary Edward.
Yeah. Mm-hmm. Yeah, nice bounce off the 50-day
Um,
moving average line today.
yeah, we're in there around 211.
Mm-hmm.
So, again, not the 10 bagger plus that SMCI was, but same theme. And these are stocks. I mean, we use it's Market Surge now, right? Not Smith anymore.
Yeah, Market Surge, right.
I mean, this is one of the tools in our toolbox for stock picking. I mean, we have a seasonal mindset, a seasonal overlay. We start looking. We run through the new stocks around the beginning of the best 6 months. October, November, after we get our buy signal, and we run through. We use Zax also. We do a full screen, looking for stocks that are exhibiting an acceleration of revenue and earnings growth and have good valuations, PEs, price to sales, cash flows, that sort of thing. And then we're looking for a little bit of relative strength. We don't want it beating the market. We don't want it lagging the market. And then we're going to also look at who's following it. Not who per se, but how many analysts are following the stock or rating the stock. So we want something that's under followed, under Wall Street's radar. I tease, especially when I'm on with you guys, that it's sort of pre-canned slim. We try to get into these things before the momentum is there, while they're humming along quietly, doing nice business and making money. And these are how these stocks end up in our portfolio. We don't get them all. On the call today with subscribers, somebody was saying jokingly, "Oh, I wish I should go back to November and put more money in all the stock recommendations."
Right. If only it were that easy, right?
But you take that hindsight and use it for foresight. You say, well, next time, let me just buy even amounts of these stocks when you've done the analysis without the emotion, and stick to your buy limits and your stop losses, and move up the stops based upon the charts. So we also do a technical analysis overlay, looking for good entry points for those stocks. So
yeah,
that's how we found. Good.
Oh, I was just going to say, and you also mentioned how you're also looking at kind of sector moves as well.
Yeah. Again, seasonal overlay there too. We have a select sector seasonalities in the Stock Traders Almanac. There's a couple of pages on that, and we take that throughout the year in the newsletter, and we pick correlated ETFs. The aforementioned XLU trade was something that we came out with in March, ahead of the seasonal bullish period for utilities, March to October, as it says in my trusty Stock Traders Almanac, always at my side. Utilities, March to October. So we got in there early March. I picked up some myself.
I think you were also talking about consumer staples.
Staples, that sector, along with healthcare, started just recently. That was last month's recommendations. The XLP and the XLV. the healthcare hasn't hit our buy limit yet. Where's that trading today? You want to pull XLV?
145.79.
Yeah, we're looking for it to come down a little bit to about 140.50, but that's
And
that's
again, going back to Friday's action, this is one that was up tremendously.
did we
I think
get it
this
on
was
Friday? No.
well, this was above the 50-day moving average line, and it was interesting how strong this was given how ugly Friday was. I mean, this was one of the only sectors that was up for a good portion of Friday, and I mean XLP too. If you go back to Friday, I'm gonna go ahead and I'm gonna change the date just so people can see what this looked like on Friday. I mean, look at XLP just bouncing strongly from the 50-day moving average line. XLU was holding up, very well, not even coming down to the 50-day at all. XLV, that was getting back above the 50-day moving average line. And again, remember, this is when the NASDAQ was, a lot of these were up and looking strong when the NASDAQ was down below its 21-day moving average line, as was the S&P 500. So definitely getting some relative strength on those for that day. Now, do you generally stick with the broad sector spider ETFs, or do you sometimes go drill down like a XBI, for instance, to get a little bit more?
We've traded the XBI as well. That's still pretty broad in my book, or the IBB.
Yeah.
XBI is definitely something that I've held before. It's not something in there right now. For sure. I mean, a sector for the future, in my view, and something we have had in and out of the portfolio many times. Biotech, big fan.
Now, we kind of, when we were looking at your seasonal charts, again, there was a little bit of chop maybe after the conventions is really when things seem to kind of get the gas, put on typically. So, a lot of these are a little bit more on the defensive side. Do you kind of switch gears? I mean, you mentioned utilities. The seasonality is typically through October, but do you kind of switch gears into some more faster horses or less defensive once those conventions finish? What's the seasonality tell you there?
Yeah, we'll start looking in August, September, but we're really going to wait for the best 6 months, signals to come in and wait for our MACD triggers in October, best 6 and best 8. So we might not get back in officially, with the newsletter signals until we get a MACD buy signal after October 1st. But that doesn't mean we're not going to be looking at opportunities if they present themselves. Another thing I want to mention, and maybe this will be, we can sort of, put a bow on things here. There's a strategy in the Almanac where it's on page 64, I think, if anyone has one or looking at it, where we combine the best 6 months and the 4-year cycle, where it says triple the returns, fewer trades, best 6 plus 4-year cycle. So in an election year, we're not selling anything if you're sticking to this strategy. And I know a lot of subscribers do this, that instead of you don't heed the sell in May signal, you don't heed the best 6 months, best day, you just sit tight, because most of the market's gains have been made not only in November and April, but also in the second 2 years of the term, the pre-election year and the election year. So you buy the midterm bottom like we did in October 2022, and then you wait until the post-election year, April sell signal or June sell signal in 2025 before you trade that, that portfolio, that strategy, that switching strategy. So that being said, a lot of the stuff with our but a little more defensive. We're still holding, some of the more aggressive stuff, even a piece of super micro. But we don't have to necessarily be thinking, when do we get less defensive? We're already less defensive in an election year because it's a more bullish year.
And just to kind of delve a little bit into that strategy, because you have a lot of statistics, right? And sometimes those statistics are very positive. As you mentioned, 90% success rate, in these certain conditions with a 17% average gain. But what about those outliers? What about those times where it doesn't work your way? Do you have kind of a sell signal to kind of tell you, okay, this is that 10%.
For the stocks and sector ETFs, yes, we have stops in there.
Okay.
For the best and worst months, we've messed with it. We've back tested it. It's best to just stick to the seasonality. The seasonality in and of itself, it has a built-in sort of, protective part because you're getting in, but you're getting in when the market's usually bear. Somebody said it the other day on one of the news things. I really have trouble getting bullish in May, and I have trouble getting bearish in October. Which is what this whole mentality is about, and it's an overlay on top of what you're looking at. And of course, if we see something, outlier, I'll call an audible if I have to.
Yeah.
To get out, but for the most part, 99% of the time, we're going to stick to for the tactical seasonal trade, we're going to stick to the seasonal period and the MACD trigger.
Yeah.
And not have a stop in there.
Yeah. Makes sense. Well, that's going to wrap it up for this week, folks. And again, as a reminder, you can get a lot of this information that Jeffrey Hirsch was talking about today, whether it's the weekly analysis, the monthly webinars, the Stock Traders Almanac. Again, you can get that at stocktradersalmanac.com, that information, and follow him on Twitter or X at almanactrader.com. Jeff, thanks a lot again for being here with us and presenting the halftime show.
My pleasure as always. Thanks for having me.
Absolutely. And thank you for joining us this week. Next week, I'm going to be on vacation in Costa Rica. So we actually pre-taped an episode with David Saito Chung. It's going to be kind of going over some of the learning lessons that we've had from Bill O'Neill himself, from our own trades, how we do our post-analysis. It started out as kind of a best and worst trades and kind of turned into some of the trades that got away. So we hope you enjoy that while I'm on vacation, and I will see you in a couple weeks. Take care, everybody.